Let me make some introductions. I'm Sarah Boyce, and after over 20 years working in corporate treasury, I now provide policy and technical support here at the ACT. Joining me are Edwin Schooling-Latter from the FCA, Olivier Gayno from HSBC, David McNally from Deutsche Bank, and Jamie Thrower from NatWest. Perhaps we could start by some brief introductions, including how you're involved in LIBOR transitions. Edwin, would you like to kick off, please?
Thank you very much, Sarah. So I'm Edwin Schooling-Latter. I'm Director of Markets and Wholesale Policy at the Financial Conduct Authority. I've had various roles and responsibilities over several years in the FCA, but one constant theme in those has been dealing with the issues presented by the LIBOR benchmark and more recently the policy on transition away from that benchmark towards stronger risk-free rates.
Thank you. Olivier?
Yeah, I'm Olivier Gayno. Good morning. I'm working with HSBC Global Asset Management. I'm basically a fund manager overseeing money market fund management in the EMEA. And I've been involved into the IBOR transition project in the company since the start. And again, it's from a user perspective that I will be speaking today.
That's great, thank you. And David?
Thank you, Sarah. Good morning, everyone. David McNally, and I'm the LIBOR Transition Director at Deutsche Bank for our corporate banking operations. And corporate banking incorporates cash management, trade finance and lending, trust and agency services, security services, as well as risk management and capital market solutions for our corporate clients in partnership with our investment banking division. And our clients are drawn from the treasuries and finance departments of corporate and commercial clients and financial institutions across the globe, many of which I hope are listening today.
Thank you. And last but by no means least, Jamie.
Thank you, Sarah, and good morning, everybody. I'm Jamie Thrower. I am the LIBOR business lead, for LIBOR transition at NatWest for our commercial and corporate bank. And I also chair the Loan Enablers Task Force on behalf of the RFR working group.
That's great. Many thanks, Jamie. So to kick us off, Edwin, perhaps before we hear from the banks, you could give us a bit of an update on the LIBOR transition scene from the regulators' perspective?
Yes, of course. So I'd like to just run over 3 or 4 key points about the LIBOR transition. I'm just going to start with very briefly recalling why we're doing this. And there is both a sort of supply side reason and a demand side reason why transition away from LIBOR needs to happen. The supply side reason relates to the issues in creating the rate, which essentially arise from the fact that LIBOR measures a market that no longer exists in the way that it used to exist. So the market for term unsecured interbank borrowing used to be a common way for banks to fund themselves, but just isn't anymore. And obviously that's not sustainable to produce a benchmark measuring something that doesn't exist in the way that it used to. Much better to have benchmarks that are grounded in actual transactions. But probably more important for this particular audience is the demand side reason. And that is essentially that LIBOR is just not the right rate for most borrowers. And that's because it exposes the borrower to an opaque and a pro-cyclical risk of interest rates rising at times of economic stress. And we got a reminder of that at the beginning of this year in March, April, when the spread of LIBOR over SONIA, which is the chosen risk-free rate for sterling, increased to around 5 times its average over the previous 5 years. Now that spread has gone down again since then, but a graphic illustration of how LIBOR can present some uncomfortable risks to borrowers, and why this move to risk-free rates should, once it's complete, leave the non-financial corporate sector with interest rates that are easier to understand and less likely to rise at times of stress. So that's the why. The second point I'd like to register as strongly as I can relates to the when this is going to happen. Now, we in the FCA said over 3 years ago now that you need to be ready for LIBOR disappearing at the end of 2021. Market participants need to be ready for announcements later this year setting out what will happen at the end of 2021. And as we've said repeatedly over the past years, the scenario that you need to be ready for is that those are announcements of cessation. Now, amidst the impact of the coronavirus and the forthcoming end of the Brexit implementation period, the end of LIBOR and the end of 2021 may still seem a problem that's quite a way off, one for next year perhaps. But I want to impress on you all that engaging with the transition away from LIBOR is a task to be addressed now and not one that can be pushed back until a future year. In fact, the next 2 quarters, so this one and the first quarter of next year, are and arguably the critical period for action on transition. So transition away from LIBOR has not been postponed because of COVID-19. And as I said earlier, the way that LIBOR behaved during this virus is actually a reminder of why we're doing this exercise. And in the course of the conversation we're about to have, 2 particular areas for action are likely to be a focus of discussion. One of those is around your borrowing, and there, from the beginning of this month, your lenders in sterling have been expected always to offer you a non-LIBOR alternative. If you do choose to borrow using LIBOR in the 6 months ahead, your lender is expected to have an agreement with you from the outset on how that will convert away from LIBOR at the end of 2021 or before. And then from the end of the first quarter next year, your lenders will not offer you LIBOR loans any longer. And the second really important area for near-term action is on the derivative side. And there, if you have interest rate swaps, for example, those are likely to be made under the standardized ISDA terms. Those terms, as they have previously existed, are not robust to the discontinuation of a LIBOR rate. So ISDA has been conducting an extensive exercise over the past years to make amendments to that documentation, which will allow those interest rate swaps to continue in more or less the way that you expect them to behave economically now. But you will need to sign that protocol if you are going to ensure that your own contracts do survive the end of LIBOR and continue to function. So those are 2 near-term current things that you are going to need to do to be ready for the end of 2021.
Great. Many thanks for that, Edwin. Let's just pick up a couple of the points that you've touched on there, and perhaps we'll start with the derivatives market, since that's actually the largest market and therefore arguably drives everything else, although not for corporates. But let's start with derivatives. David, do you want to give us a bit of an update as to where transition is in the derivatives market? Edwin's obviously made mention of the ISDA protocol. Perhaps you could explain a little bit more about what that actually means, what that is for people?
Certainly. So I made perhaps a few comments first on the development of the derivatives market and its liquidity, at least those instruments that now use risk-free rates as their underlying. And then actually I'll pick up a little bit on what Edwin's already touched on and some practical steps that need to be taken with respect to documentation. So first up, the SONIA derivatives market is already very liquid. And in fact, it overtook sterling LIBOR both in terms of volumes and liquidity in 2020. So that makes the sterling market the most advanced in the transition across the major currencies so far. A further catalyst that will promote liquidity in the SONIA-based market include the SONIA First initiative. So that's one of the Bank of England's targets published. And what that means is that interdealer brokers, to quote SONIA First, when pricing sterling interest rate swaps. And that is expected to take place later on this month, on the 27th of October, and will further boost liquidity in SONIA-based instruments. So very positive progress in sterling-based contracts. Now, volumes of SOFR derivatives, the dollar risk-free rate, are increasing, but at this point in time remain well below the volume of dollar LIBOR contracts. Although in October again, later this month, the change from using effective Fed funds rate to using SOFR for the discounting of collateral is also expected to boost SOFR liquidity. So what that means in practice is that SOFR will be used as the remuneration rate for US dollar cash collateral, and therefore determines discounting curves for the underlying exposures. And then looking a little further ahead in the dollar market, in Q2 next year, the central counterparties will no longer accept new swap contracts for clearing with effective Fed funds as the price alignment interest, except for the purpose of closing out or reducing outstanding risk in legacy contracts that use Fed funds as the discount rate. So there's a few more things to happen in the dollar market. Just lastly, very briefly on the euro market, really only a few derivatives are referencing ESTR since its launch in October last year. So there remains much more to happen in the euro currency. So there are my comments, I think, about the breadth and depth of the market. And perhaps just taking a step back to some of Edwin's comments on fallbacks, perhaps first just a very brief primer or 101 on what fallback language is. So it refers to the legal provisions in the contract that apply when those external events occur. And as Edwin said, historically, fallbacks in financial contracts, and this doesn't just apply to derivative contracts, this is across all financial instruments, have historically only been designed to deal with the temporary unavailability of a benchmark and not necessarily the permanent cessation of a benchmark like LIBOR. So those fallbacks need to be amended and made much more robust for when LIBOR permanently disappears. So practically speaking, ISDA, again, picking up on Edwin's comments, have undertaken a major initiative to make that as easy as it possibly could in the circumstances by the prospective publication of that fallbacks protocol, which specifically covers IBORs. And this seems likely to be made available now in the very near future, subject to some final checks and balances by various regulatory and legal authorities. So that protocol's availability is expected to allow at least those contracts that reference ISDA terminology for adherence and to update those fallbacks to cater for LIBOR's discontinuation. And that the effective date of that language is expected to be sometime, I think, in January next year. Mm-hmm. So as Edwin said, the practical steps here are, once that event has taken place, speak to your swaps dealer if they haven't already spoken to you. And my words of encouragement are to take that step as soon as it's reasonably practical in the new year or before, as the case may be. So now that we're on I think in summary, we're on a very clearly defined path for derivatives. at least the rump of, if you like, of the derivatives marketplace. Although attention is now turning to some of the finer details, for example, for dealing with the transition of non-linear derivatives instruments. And the risk-free rate working group has created another sub-working group, recently created, which is actually co-chaired by Deutsche Bank. But for the purposes of my comments today, I think we'll say there's more on that to come. So please keep your eyes peeled for any recommendations that come out from that group on non-linear instruments.
Just a very quick question. What's a non-linear instrument?
So I'll give you an example, Sarah. Thanks for the question. A swaption. That's right. A swaption is a good example. So an option on a swap.
Thanks. It's it's easy to assume, and most of the time I have no idea what's going on. So yeah, first principles. Thank you very much indeed for those comments, David.
I'll make one more comment just to answer your question slightly differently. I mean, I think it's fair to say that one might expect the institutional marketplace to take the lead on the development of transition for the non-linear market. Again, as I said, something for this community to keep very close eyes on.
Yeah, no, that's a good point. Thank you very much indeed. Olivier, perhaps you could give us a bit of a different perspective, coming from more of the end user side, if you like, of the spectrum. What are you seeing when it comes to IBOR transition? Are the markets that you're operating in, are they done?
Yeah, just echoing what has been said, the market are not yet done, but progress is clearly being made. When we look at what's happening, for example, into the money market space, which is a big user of such rates, we can see that the SONIA issuances are more and more frequent in commercial paper or certificate of deposits. But as echoed earlier, I believe that the SOFR usage is a little bit less advanced. What we are seeing mostly is government, quasi-government agencies, issuances of SOFR paper, but not so many, I would say, banks or non-financial corporates issuing commercial paper in SOFR. It's coming up, but it's still needs to be more frequent. And Euro is definitely the laggard here. And I think the reason is that everybody feels confident that transition in Euro from EONIA to ESTA would be a very easy one, because EONIA is already defined as a direct calculation from ESTA. So everybody is assuming that the transition will be easy. However, I'd like to see more ESTA issuance directly and not rely too much on I would say, an easy transition to make it a late transition. So that's what we are seeing into that space. One final word into the asset-backed securities as well, which is a big market for floating rate notes, floating rate bonds. Again, we are seeing, SONIA taking the lead here in terms of issuances, which is also a very good news. So that's what we see in the market from a user point of view. Now, we are producing funds, if I may say produce. We are offering funds in the market which sometimes have benchmarks, had benchmarks related to LIBOR, and we are undergoing that transition. And the market is undergoing that transition as well. We have done already quite a lot, and we expect our liquidity fund to be all into referencing risk-free rates, nearly risk-free rates by early next year. About half of those are already done. We're expecting the other half to be ready by beginning of next year. And we'll have also to deal with very quickly within the new year into absolute return funds as well, and to end up with some, I would say, alternative funds which are referencing LIBOR. One of the trick being that some of the funds have performance fees for the marketplace, which is obviously compounding the issue, but we are pretty confident that we can cope with that pretty early next year.
Okay, that's great. Thank you very much, Olivier. It's always interesting to hear a slightly different perspective to the one that we hear bluntly day in, day out on other topics. Turning to loans, bonds, borrowing, basically, which probably for most corporates is they're going to be there when it comes to financial instruments, their key area of concern. Jamie, do you want to give us a little bit of an update where we are? Perhaps if we start with sort of if we want to transact new transactions. I think Edwin touched on it coming in, but if you could give us a little bit more colour around if the market's really there yet, I guess.
Yeah, of course. So I think we're in a very different place from when I spoke at this event earlier in the year. At that time, the conversation was around a small series of bilateral transactions that lenders had undertaken with, I guess, interested counterparties, both sides looking to explore and understand what transition meant and how to accommodate to adapt to SONIA facilities. Since then, through the Sterling RFR working group, we published the recommendation for conventions on loans in the UK market, which was a very important deliverable in order to enable banks to design consistent product and for borrowers to understand what to expect in engaging with that product and what they needed to do in order to accommodate. Those were published, I think, about 6 weeks ago or so. Time kind of has no meaning in this current climate, doesn't it? But I think about 6 weeks ago. And as Edwin kind of said at the outset, what also occurred last week was the requirement for lenders to offer alternative products to LIBOR, or for any borrowing that takes place on LIBOR to include a switch mechanism there. Now, borrowers and lenders have been executing transactions on a switch basis for some time. And I guess just to cut through some jargon and clarify what that means entering into a LIBOR contract from the outset, but the provisions for a transition to the SONIA rate are all sort of predetermined and preset within the contract. So when you hit that date or see that transition date from LIBOR to SONIA effected, there's no requirement to do anything with that contract. You don't need to go back into that contract and perform any sort of active transition, if you like. So it's a very nice construct to enable, I guess, adherence to the requirement to be lending and borrowing on a non-LIBOR basis, while it still sort of has the familiarity and the kind of ease of execution that a LIBOR facility brings. So a popular product, there have been a number of those such transactions in the market. The LMA actually is probably the best place to go and look at. They provide a list of all transactions that are made public on that basis, which I think is gives good cause for optimism. What we're seeing very recently, and the fun thing about LIBOR transition is that everybody's innovating all the time, and every transaction at the moment that takes place is the first of its type, which is kind of fun and lots of kudos for about a week, and then next week something else happens, and the week after something else happens, and the market develops. So what we've seen more recently, I'd say towards the kind of blue chip end of the corporate spectrum, is borrowers actually going straight to a kind of day one SONIA or day one SOFR facility. So they are I guess, embracing transition and looking to actually do everything now and execute those facilities on a SONIA basis. So sort of skipping the, if you like, interim hybrid agreement of a switch mechanic. And we've seen those done on a bilateral basis. We've seen that, interestingly, done on a series of bilateral bases. And we've also now seen that done on a syndicated facility. So real evidence that there is that traction, that ability, that level of understanding and awareness in the market to deliver both those types of product, which I think should be really encouraging for this audience as they start to engage with their lenders from now, going forwards around what the product set looks like, and with the publication of the conventions, with the number of lenders involved in these larger syndicated facilities, that ought to create a pretty consistent experience across different lenders and different lenders' product sets. So that's where we're at, I think, in terms of new transactions and what the product set looks like going forward. I guess the key to all of this is then transition. So transition isn't only from LIBOR to SONIA; it sort of has the broader meaning around transitioning your facility from one to another, and everybody that has a LIBOR-linked facility that has a maturity date beyond 2021 sort of needs to pay attention and proactively transition that facility from LIBOR to a SONIA basis. There are, I guess, differing ways of doing that. One of those, I think, is essentially and arguably the preferred solution, is to simply engage and have that conversation with your lender and execute a very, very simple amendment agreement, which doesn't touch any other aspect of your contract, but sees you switch to, I'm going to stop saying switch, sees you transition from LIBOR to SONIA at a determined date and on a determined basis. And as I say, the expectation there is that no other aspect of the contract is touched or opened, no commercials are kind of revisited. The only thing that is amended is the benchmark. The other approach is to sort of do that a little bit more, I guess, on a staggered basis, which would be to insert a switch mechanic so that you don't transition necessarily directly to the RFR on the date that you execute that agreement, but you execute the agreement anticipating a set date in the future at which that transition will occur. But both ways are entirely appropriate. I think I'm nervous about giving advice, but my small a advice would be to understand what the most appropriate methodology looks like for you. Where does transition sit, and what else is going on in your across your lending exposures? That when is the right time to transition, bearing in mind that, as I say, executing the agreement at actual transition don't necessarily need to be one and the same, don't necessarily need to happen on exactly the same date anymore. I think the one thing that I would want to state, and I know that if I don't, Edwin will, is to pick up on some of David's conversation in the derivatives market about fallbacks. Please do not make the assumption that fallback language in your loan agreement gets you to a happy conclusion post cessation of LIBOR, and that you do not therefore need to engage or do anything proactive with your contract. The loan market is a very different place to the swaps market in this respect. and relying on fallback is not a particularly sensible strategy, if I can put it that way. So the message is very clearly around proactive engagement and active transition of contracts rather than a sort of passive wait and see and rely on some existing language to kick in to kind of accommodate, as David said, a scenario of a temporary unavailability of a reference rate, not a complete cessation. Okay. I don't know, Edwin, if you want to sort of come in on that, or Sarah, if there's anything else.
Edwin, did you want to say anything on that, or?
Jamie makes a really important point that particularly for older contracts, fallback arrangements probably did not anticipate the permanent cessation of an IBOR. So don't rely on there being a smooth mechanism in that contract to ensure contract continuity when LIBOR ceases. That is very definitely the case under the standard ISDA language, which is why you are going to need to get out and sign ISDA's protocol if you have legacy LIBOR referencing derivative contracts. But it may well be true in borrowing contracts as well. So you need to take a look at them and work out and establish confidence that they're going to continue to work in the way you want them to work after the end of LIBOR.
And actually, just building on that point, it's really worth reiterating the fact that fallbacks, to the extent that they exist in your lending facilities, are very possibly different to your swap fallbacks. So to the extent that you have hedge accounting, hedge effectiveness, if you don't look at everything together, you really do run the risk of actually losing some degree of hedge effectiveness there. The accounting ISB have come out and stated that obviously that's not their intention, but from an economic perspective, you absolutely need to make sure that you don't have an unintentional effect of losing effectiveness. More than enough from me.
Sarah,
Edwin.
Sarah, sorry, if I may just add to your point there, guys. It's
Absolutely.
Not just one. I mean, the hedge accounting point is a very important one, but see, actually, one of the questions that's popped up is on basis risk, and on that note, I mean, I would just add that the looking at all of your exposures in the round, whether it be through a derivatives instrument or a cash instrument, has to be the starting place. And in fact, in my experience now, some corporates that we've discussed this with already are deliberately putting almost like a project plan around how they're going to approach transition to eliminate any potential basis risks that exist, and obviously ensure consistency on their documentation. And so I would just encourage the audience again, if they haven't done so already, is to get a 360-degree view of your exposure and pick up the phone and talk to your banker about how you want to execute that transition plan.
Yeah, no, that's excellent point. Thank you very much indeed, David. And actually, as there are a number of questions already coming in, as is my way, I'm just going to bounce around a little bit, gents. And perhaps we could talk a little bit about, and this is for you, Edwin, I'm afraid, international coordination. There's a question that's come in asking specifically about coordination with the EC, and I think that's out of the back of the BMR initiative that's coming from there at the moment. But perhaps you could just give a couple of minutes to explain, how everybody's working together on this, or not.
Yes, thank you. It's a good question. I'm going to keep this at high level. Obviously, enormous amount of coordination taking place. But there are, of course, 5 LIBOR currencies. There's sterling, but there's dollar, Japanese yen, Swiss franc, and Euro LIBOR. So this is a very international exercise, and there's been a very intense coordination between the FCA, Bank of England, and their counterpart authorities in those other jurisdictions. Including with legislators in those jurisdictions. So there are plans afoot in the UK, in New York State, and in the European Union to make sure that our legislative frameworks for benchmarks give us the maximum possible opportunity to make the transition away from LIBOR as smooth as possible. And I'd like to reassure you all that notwithstanding Brexit, we can and do still talk to colleagues and counterparts in the European institutions and the European Commission and can work out ways of making sure that our respective legislative frameworks continue to work well to protect market participants.
Thank you, Edwin. And we've had a question, possibly for Edwin, but actually I think I'll direct it somewhere else, to be fair, around term and where people see the use of term rates being useful or not. I mean, the way the question has been phrased is that they are suggesting that if banks don't offer a forward-looking term rate, then somebody else will. Not quite sure who that somebody else would be, but more broadly, perhaps somebody could just comment on whether or not, where we are on term rates, where you think they might be used. Maybe it's one for you, Jamie, actually.
Sure. So I guess there's been a kind of period of consultation around what the appropriate use case looks like for a term rate. I think it's been very clear from word go that in choosing SONIA as the replacement benchmark rate, Edwin has talked about the kind of positives that brings over LIBOR and why that is a step forward and an enhancement or an improvement to a LIBOR scenario. It is natural for all participants to look at that and think, crikey, that's a bit different, that's backward looking, that doesn't, I don't know what that looks like, so how can we create something that sort of looks, smells, feels like this LIBOR that I'm very used to? And I think it's been very clear, as I say, from the outset, that it has been the job of all involved to actually embrace that change and undertake kind of programs of awareness and education to explain the differences and explain how SONIA actually works in practice. And certainly what I've found is that when you have that conversation with borrowers, it resonates. The kind of advantages are clear and outweigh the disadvantages, if you like. And so the cry for term, I feel, has subdued significantly over the last 12 months or so. That said, there are certain sectors and product types where a forward-looking rate is a requirement, and I'm thinking particularly around the sort of trade and working capital product areas where there's an element of discounting or factoring involved. Those are called out and kind of explicitly contemplated by the term rate use case work. And at the moment in the market, I believe there are 3 providers trialing term rates with a view to those becoming kind of something that people can use in anger later on this year. So I think term exists. All banks will offer a form of term product in those very sort of discrete sectors that require it. But for the bulk of kind of commercial lending, if you like, it's simply not on the table. And as I say, my experience is that through having that conversation, that engagement, and kind of getting hands-on with SONIA and understanding what that looks like and what changes one needs to make to running your business in order to accommodate that, that actually this trade-off between certainty versus lack of volatility, borrowers are finding actually that it's the lack of volatility that is kind of more important, and the, I guess, knowing your interest rate or your payment due on day 85 out of 90 rather than on day 1 is not quite the sort of insurmountable challenge that the market originally thought it was when Sonia was announced as the preferred successor.
Sarah, I'll add very briefly to that. The first thing to say is I think everyone on the inside of this exercise is very confident that the future centre of gravity of interest rate markets is going to be those overnight rates compounded in arrears. And that, for example, is one of the areas where there's a very strong international consensus too. So it'll be SONIA compounded in arrears in the UK, SOFR compounded in arrears in the US. In Switzerland, they're not even going to have a forward-looking term rate based on SARON. So if you are looking to manage those basis risks and hedges in the way that David very usefully highlighted earlier, you need to be looking in sterling at SONIA compounded in arrears. Now, there's a very good paper on the Bank of England's website about where a term rate might be the right relevant rate to use. We are going to make sure that a forward-looking term rate based on SONIA is produced, so that will be available for those minority areas, but it is not going to be the centre of gravity of interest rate markets in the way that forward-looking LIBOR rates used to be.
That's very helpful. Thank you very much indeed. And I'm very aware that we never have long enough for these LIBOR conversations, and we're just about to run out of time again. So perhaps literally in 30 seconds each, you could perhaps let me know, and Olivier, I'll go with you first. What do you think corporates should be doing now and maybe over the next 6 months?
I think that it's very important what has been said about really looking at the whole exposure. That's what we've done, taking all the bonds exposure that we have across the firm, assessing the fallback language quality, and if it's not engaging with the issuers, that's exactly what we are doing at the moment. And we are even doing something a little bit more, which could be useful for corporates as well, which is that on each of those bonds, we are building some valuation scenarios whereby, for example, if the fallback language says that in case of a LIBOR is not available, it will be set at the last fixed coupon. That could be, for example, a kind of language. Then that gives a kind of different framework for valuation, and that gives an alternative valuation. And based on this, you have a set of action that is possible. So it's really looking at the whole exposure, assessing the fallback quality, engaging with the issuers in asset management case, probably with banks in the corporate case, and making valuations of the current terms of your exposure.
That's great, thank you. And I'm very aware of time. Is there anything that anybody else would like to add to that? No, I will take silence as acquiescence.
I'll go if you want, Sarah. It's David.
Yeah.
Look, on the back of those comments about from Olivier about being prepared. Look, if your bank hasn't been in contact with you yet, then as in my previous comments, do pick up the phone and speak to your relationship manager. If you're lucky enough to bank with Deutsche Bank, that's going to happen very soon. And I expect many peer institutions are about to kick off their outreach programs now that the rules of the future game have really been established. So Edwin's call for action is the thing I think is the most important takeaway. The next 2 quarters are going to be critical.
Yep, thank you very much indeed. And yes, all banks, there are other banks than Deutsche Bank, obviously.
Indeed.
Right, we have definitely run out of time. So thank you all very, very much indeed. And we will try and schedule these for longer going forwards. Please do not do nothing. I don't think we could be any clearer about a call to arms. There's lots of information available either from your banks. If you go into the exhibition hall, there are both banks and systems providers there you can talk to. So please do something. I'd like to say thank you to Edwin, Jamie, Olivier and David, and enjoy the rest of the conference. Thank you.